Welcome to Accounting for SS1 at Light Tech Academy. Today we study the general ledger, posting and balancing. What is the ledger? The ledger is the principal book of account. It contains all the accounts of the business. Every transaction that has been recorded in the books of original entry must be posted, transferred, to the ledger using double entry. Double entry principle. Every transaction has two effects, a debit, DR, entry and a credit, CR, entry of equal value. The rule, for every debit there must be an equal credit. The accounting equation, assets equals liabilities plus capital. Types of ledgers. 1. General ledger. Nominal ledger contains accounts for income, expenses, assets, liabilities, and capital. This is the main ledger. 2. Sales ledger. Debtors ledger contains personal accounts of all credit customers, debtors. 3. Purchases ledger. Creditors ledger contains personal accounts of all credit suppliers, creditors. Format of a ledger account, T account. Every ledger account has a T-shape with two sides. Left side equals debit, DR, side, date details folio amount. Right side equals credit, CR, side, date details folio amount. Debit and credit rules, the golden rules. For real accounts, assets debit what comes in. Credit what goes out. For nominal accounts, income and expenses debit all expenses and losses. Credit all income and gains. For personal accounts, debtors and creditors debit the receiver. Credit the giver. Simpler way to remember. Assets increase debit. Assets decrease credit. Liabilities increase credit. Liabilities decrease debit. Capital increases credit. Capital decreases debit. Income/revenue increases credit. Income decreases debit. Expenses increase debit. Expenses decrease credit. Posting from books of original entry to ledger. Example, sold goods on credit to Mrs. Okonkwo for 50,000 Nigerian nairas. Source, sales day book sales invoice number 005. Double entry, debit Mrs. Okonkwo's account, sales ledger, 50,000 Nigerian nairas. Credit sales account, general ledger, 50,000 Nigerian nairas. Example 2, paid electricity bill in cash 8,000 Nigerian nairas. Source, cash book. Double entry, debit electricity account, general ledger, 8,000 Nigerian nairas. Credit cash account, general ledger, 8,000 Nigerian nairas. Balancing a ledger account. At the end of a period, each ledger account is balanced. Step 1, add up both sides, debit and credit, separately. Step 2, find the difference between the two totals. Step 3, insert the difference as balance carried down, BECE/D, on the ledger side to make both sides equal. Step 4, write the same figure as balance brought down, BECE/D, on the opposite side at the start of the next period. Step 5, both sides must now show the same total. Worked example, balancing a ledger account. Electricity account, general ledger. Debit side. July 10th, cash 8,000 Nigerian nairas. July 25th, cash 5,000 Nigerian nairas. Credit side. July 31st, balance C/D 13,000 Nigerian nairas. Both sides total, 13,000 Nigerian nairas. August 1st, balance B/D 13,000 Nigerian nairas. On debit side, expenses have a debit balance. Sales account, a general ledger. Debit side. July 31st, balance C/D 210,000 Nigerian nairas. Credit side. July 31st, sales day book total 210,000 Nigerian nairas. Balance B/D 210,000 Nigerian nairas on credit side, income has a credit balance. Normal balances. Assets, debit balance, e.g. cash at bank 50,000 Nigerian nairas DR equals you have 50,000 Nigerian nairas. Liabilities, Credit balance, e.g. loan 100,000 crore Nigerian nairas equals you owe 100,000 Nigerian nairas. Capital, credit balance. Income/sales, credit balance. Expenses, debit balance. Folio references. Every ledger entry includes a folio reference, a cross-reference to the source of the posting, e.g. CB equals cash book, SDB equals sales day book, PL equals purchases ledger, SL equals sales ledger, GL equals general ledger. This creates an audit trail. Remember, ledger equals principal book of account equals contains all accounts of the business equals every transaction posted using double entry. Double entry principal equals every transaction as two affects equals debit entry plus credit entry of equal value equals for every debit there must be equal credit equals assets equals liabilities plus capital. Types of ledgers: general ledger/nominal ledger equals income plus expenses plus assets plus liabilities plus capital equals main ledger. Sales ledger/debtors ledger equals personal accounts of all credit customers. Purchases ledger/creditors ledger equals personal accounts of all credit suppliers. Format of ledger account/T account. Left side equals debit/DR equals date plus details plus folio plus amount. Right side equals credit/CR equals date plus details plus folio plus amount. Golden rules: real account/assets equals debit what comes in plus credit what goes out. Nominal account/income plus expenses equals debit all expenses plus losses plus credit all income plus gains. Personal account/debtors plus creditors equals debit the receiver plus credit the giver. Simpler: assets increase equals debit, assets decrease equals credit, liabilities increase equals credit, liabilities decrease equals debit, capital increases equals credit, income increases equals credit, expenses increase equals debit. Balancing: add up both sides separately, find difference, insert as balance carried down /ball C/D on larger side, write as balance brought down /ball B/D on opposite side at start of next period. Normal balances: assets equals debit balance, liabilities equals credit balance, capital equals credit balance, income/sales equals credit balance, expenses equals debit balance. Folio references equals cross-reference to source of posting equals creates audit trail. Thank you and keep excelling at Lightech Academy, powered by Lightech Solutions Limited.